With the Secure Act 2.0 on the verge of getting passed, here's 3 big changes that could affect your retirement. The Secure Act 2.0 just passed the House a few weeks ago. It hasn't gone through Congress yet. It might be accepted as is. It's probably going to make some changes before it goes through. But let's talk about some of the big changes, how that can affect your retirement. There's a lot of pieces to it. We're not going to go over every single piece to it, but I think some of the big changes I want to talk about. Let's start first with catch-up contributions and how these could possibly change based off the Secure Act 2.0. Right now, if you have an employer sponsor plan, 401k, 403b, TSP, deferred comp, which is 457, right now you can contribute up to $20,500 maximum contributions into these plans if you're under 50 years old. But if you're 50 and older, you can contribute an additional $6,500, which brings you up to $27,000 maximum contribution. Under the new proposed bill, they're looking to increase the catch-up from $6,500 to $10,000, but not for everybody, only for people who are 62, 63, or 64. So just those 3 years are allowing people to put additional $3,500 into their employer sponsor plans, I think, just to make some extra catch-up contributions before retirement. Interesting thing is the other change on the catch-up contributions is they don't want those catch-up portions to be tax deferred. You remember when you contribute to a 401k, most of it's pre-tax, you get a tax deduction when you contribute it, and even on the catch-up portion. But now what they want is that catch-up portion, either $6,500 or $10,000, to be treated as Roth. You pay your taxes on that money. So that's going to be a taxable event. So you're not going to get that deduction on the catch-up portion. The other big part of this is on the employer side. Right now, the employers don't have the option to contribute to a Roth. So even if you're doing Roth contributions, they're always putting their match into the pre-tax portion. But now you can have the ability, if the plan allows it, to have the employers contribute into the Roth portion. But it's not tax-free. It's not going to be free money. They're going to add that Roth contribution from the employer to your gross income. So it will be taxable. But still, I think long-term it's going to be a good thing. So definitely look into that if that's an option. Now, when we get to the IRAs, right now you can contribute $6,000 to an IRA, a Roth IRA, if you're under 50 years old, and that additional $1,000 for that catch-up contribution. Right now, they're looking just to increase that catch-up contribution based off inflation. So indexing it up with inflation each year, so that $1,000 would slowly grow a little bit each year as well. Last thing on the IRAs is when it comes to SEP IRAs, right now, these are these employer-sponsored, IRAs that right now can only go into the pre-tax. They're allowing SEP IRAs to go into a Roth portion, so that's an option as well. Number 2, let's talk about RMDs, required minimum distributions. Remember back in the day, a few years ago, not too long ago, required minimum distributions started at 70.5. And that's why I joke and said the IRS has been patient long enough. They said now you have to start taking money out of your retirement accounts and start paying taxes on this money. Well, the Secure Act, the first version came out, was implemented a few years ago, and that changed it from 70.5 to 72. Right now what they're looking to do is change those dates. So this year, if it went into effect, they would postpone RMDs till age 73. And then in the year 2029, 7 years later, they would change the RMDs to age 74. And then 3 years after that, to the year 2032, RMDs would be age 75. So that's what's on the books here to postpone RMDs. I think that would help for some who don't want to be taking them out, but also you have to remember those multiple years waiting allows that money to keep compounding, which makes your RMDs bigger. So who's really winning, who's really losing, right? So the taxes are still going to be higher most likely in the future. So, and we don't know what these tax rates are going to be. So that's a big unknown with these postponed RMDs. And lastly, let's talk about the penalty. What happens if you don't take, and I've talked about this on previous episodes, if you don't take your required minimum distribution in the year you're required to do so, it's a 50% penalty of what you're supposed to take out. So for example, that's under the current rules. For example, if you had $1 million IRA, and that means if pretend you're 72 this year, you're required to take out $36,500 roughly. If you missed it, it's an $18,250 penalty. What they're proposing is to drop that 50% penalty to 25% penalty, which is still very high anyways, but knocking that penalty in half. But there's also ways to get away from that penalty. There's a form to fill out from the IRS that if you didn't understand the rules and you go back and you take out all your RMDs that you missed, they would most likely forgive you as long as you do the proper protocol and pay the taxes on the money that you missed. But again, dropping the RMD penalty from 50% to 25%. So those are the three big changes. There's a couple other things too that are in the works, which is QCDs, qualified charitable distributions, talking about increasing those with inflation. Right now it's capped at $100,000 and a qualified charitable distribution, but increasing that with inflation. And then also for the younger employees out there starting their careers, if they have a lot of student loan debt, which we know a lot of these college graduates are walking away with $35,000, $45,000, $50,000 in debt, if they're in that repayment plan of their student loans and they're making those student loan payments and they can't afford really to contribute to their retirement accounts, their 401ks and so on, they can still get the employer to match as long as they're showing proof they are contributing or paying off, I should not say contributing, but paying off their student loans. If they're in that process, they can get the employer match without actually contributing themselves into the IRA, to the 401k, 403, 457 and so on. So there's some good tips here. The big things are contributions, big changes, RMD pushing those dates out, and the penalties dropping most likely. Hopefully some of these will come to pass here. We'll see in the coming weeks. Hopefully it will go through. Like and subscribe, please. Follow this page and follow these stories on retirement. I appreciate all the comments and appreciate all the people listening in, watching, and liking this page as well.